The dangers of defaulting on federal student loans. When a borrower defaults on their federal student loan, the U.S. Department of Education reserves the right to administer federal wage garnishment orders, destroy an individual's credit, seize federal and state tax refunds, refer the loan to the U.S. Department of Justice for litigation purposes. They can revoke eligibility for additional student loans, FHA and VA loans, and the Department of Education even reserves the right to withhold professional licenses. And to make things even more complicated and more complex, every borrower is required to sign a federal contract called the promissory note in order to take out their loans. What the lenders don't explain to these individuals that in the fine print, if the account were to ever go into a defaulted collection status, the borrower agrees to pay the balance off in full. Now remember, this is all agreed to on a binding contract that was signed by the borrower. They actually reserve the right to assess up to 25% in collection penalties and fees and charge any attorney and court costs if necessary, basically meaning if they were to actually litigate against you. And to make things even harder for you to pay off your loan, the payments that are applied towards your loan after your loan's default are only applied towards interest and penalties, which is the collection costs. Now, Department of Education only has pretty much one overall goal, and that is to maximize their profits. By doing so, they actually contract numerous collection agencies, whether it's on the large business scale or the small business scale, but all these collection agencies are competing to be ranked number one on Department of Education's scoring system. So you can kind of take a look right here. Some of these mottos for these collection agencies are a little bit disturbing, to be honest with you. If you kind of take a look right here, Conserve, the collection agency for higher education. You can see right here they were Department of Education's #1 top performer, so they're actually proud of this, proud of recovering the most money for Department of Education. Next one right here is actually very disturbing. If you kind of look at Premier Credit of North America, their motto is turning bad debt into cash guarantee. So they consider the money you owe bad debt. I really don't know why they would want to put such a thing on there. Obviously these collection agencies are not out there to help the borrower, but their best interest is for their client, which is who is owed. Now, here's some more insider's knowledge on what really goes on behind student loans defaulting. When a student loan defaults, the interest that was owed prior to default is actually capitalized into a new principal. So what that basically means, for example, if there was $3,000 worth of interest and the account defaulted, that $3,000 is actually going to be added to the principal balance. Now keep in mind, as far as the interest growth is obviously a percentage of your principal. So at that point in time, what that basically means, if they do that, is that you will basically owe more and you will accrue interest a lot more rapidly. Now, going back to the collection fees that was mentioned earlier, Department of Education obviously reserves the right to assess up to 25% of the combined principal and interest in collection fees. So to give you an example on how vicious the cycle is, if an individual owes a principal balance of $30,000, interest in amount of $5,000, that gives a combined principal and interest of $35,000. Now, if they were to assess up to 25% worth of collection fees, then at that point, what that comes out to, the total figure is $8,750 worth of collection fees just for your account going into collections and into default. So if you kind of take a look how vicious the cycle is, $35,000 plus that $8,750, that gives an overall balance of $43,750 that is due immediately. It's very difficult, as far as that $8,750, that's a quarter of your balance, which is completely ridiculous. And to make things even worse, and yet it does get worse, the collection fees is, once again, 25% of the combined principal and interest. So that, with that being a set percentage, as your interest goes up, so do those collection fees, believe it or not. So let's just say, going back to the example, you have a $30,000 principal, and for example, let's just say you were to be accruing interest at an 8.25% annual rate, which is fairly common for loans in default. What that basically means is after 1 year of interest accrual, that comes out to $2,475 worth of interest growth. Now, with that $30,000 principal and the $5,000 worth of interest that was owed before, including the $2,475 after a year, That gives you a combined principal and interest of $37,475 after a year. So if you go ahead and add collection fees to that at 0.25%, remember it's a set percentage, your collection fees actually go up to $9,369 compared to where it was before, which is $8,750 1 year ago. So with that $2,475 worth of interest growth after a year, including the $619 increase in collection fees, that's a $3,094 increase in your loan balance in only 1 year. Now, a lot of people get stuck in this situation, they get stuck in this financial snowball, and they get left with nowhere to go. We actually have solutions to your problems. All you need to do is just go ahead and visit freestudentloanstuff.com. Once again, that's freestudentloanstuff.com.